Wise World Investment Planning, Quarter 2, 2022. It's time to talk about tax strategies for both individuals and businesses. Tips, techniques, things that are working in the current environment, what's going on that you need to know about. Let's dive in. Individuals is a good place to start. You are an individual. You may also be a business owner. So let's look at individuals first. RMDs, upper left corner, required minimum distributions. You're familiar with those. If you are over the age of 72, not your real age, but your chronological age, you get to start taking money out of your IRAs, individual retirement accounts. Because if you don't, Uncle Sam, Uncle Caesar, Uncle Joe, whatever you want to call our current system, there's a penalty equal to 50% of the required minimum distribution amount shortfall. So a quick example is in order. If you were supposed to take out $10,000 based on the calculations, looking at the IRS tables, and you didn't get to it that year, the penalty is indeed half of that, or a $5,000 penalty. So Uncle Sam would like you to take this quite seriously. Now it's time to dig deep for charitable donations. All of us know that there are people in need. There are needs around us, and there will always be people that need charitable donations. Looking into the CARES Act, looking into limit on contributions increasing, looking at non-itemized deductions, cash donations. Do some homework. So work with your tax preparers, work with your tax planner, see if you have charitable intent, and if you do, take advantage of current laws. All right, now it's time to harvest capital gains or losses. A lot of people do this once at the end of the year. We recommend a little more proactive approach where you do it on an ongoing basis throughout the year. Quarterly is better than annually. Monthly is even better if you can do it, so good, better, and best. Number one, short-term gains, $3,000 off ordinary income. So if you have lost money on your investments, that's not a good thing, obviously, but at least from a tax planning perspective, there's a silver lining. You can take up to $3,000 of losses against ordinary income. Number two, long-term capital gains rates remains 20% for the majority of us. So depending on your tax bracket, depending on the income levels you receive, most of us can think of long-term capital gains at 20%. However, some individuals are only going to pay 15% if you're in a lower income bracket, and we can get into this with you in detail. Or some listening to this today might pay zero taxes on capital gains. So the three rates again are 0, 15, or 20. And a tip, number 4, tax change proposals would increase the maximum 20% long-term capital gains to 25 or maybe even 39.6. We will continue to keep our eye on Congress because they continue to write laws that impact you and I, the individual. All right, upside, the child tax credit. The American Rescue Plan, or ARPA, oh, Congress loves their acronyms, enhance the child tax credit, or CTC. If you're a physician and you have children, you're going to want to research this. Maximum credit went from $2,000 to $3,000. Age was increased to 18, up from 17. It's fully refundable, which means you're going to get that money back if you qualify for it. That's kind of nice. Only for 2021 and 2022 as of now. Stay tuned to this channel. Congress is making changes as we speak. All right, nursing a medical expense deduction. Nurses come in and provide care, keep an eye on things, make sure things work well. That's what you need to do. Keep an eye on your itemized deductions, specifically as it relates to qualified medical expenses, because they have a little speed bump. Congress got a little creative here of 7.5% of your adjusted gross income. So for example, let's say you're married and your wife has expenses and you have expenses, or the details. If you do them separately and you don't coordinate and you don't work this out, you're probably never going to get more than 7.5% of your adjusted gross income in qualifying medical expenses. That's something that you have to communicate and coordinate. Why don't you have your procedure the same year your wife does, for example? All of a sudden, yay, we get a tax break this year. You've got to work through this. All right, setting up an installment sale. If you have sold real estate, or if you've sold other capital assets and you get paid all at once, guess what that's going to do? Oh boy, get ready. The income's coming in, taxman's getting excited. You can see Uncle Sam rubbing his hands together. You want to make sure that you consider all of your tax options. So work with your tax preparers, your tax planners. Look at, maybe you want to get the income over 2 or more, 5, 8 years. Spread it out. Otherwise, it's going to take all the fun out of that awesome sale you had. All right, paying for the next semester early. Some of us have kids in college, grandkids, ourselves. We're always learning. So if you're a parent of a child in college, you should be getting up to $2,500 per student. Yes, the AOTC, American Opportunity Tax Credit. It's gone over many generations and different names over the years. That's the current configuration. Those of you that are not in college, but you're still learning, you're going to seminars, you're improving yourself, getting better at your career, there's a lifetime learning credit, an LLC, clever acronym, of up to $2,000 maximum per taxpayer per year. Remember, that's 20% of up to $10,000. So you don't get the full $2,000 unless you actually invested over $10,000 that year into your own lifetime learning. All right, time to schedule a vacation home getaways. Some of you love rental properties. If you rent it out, you can deduct the expenses like utilities and property taxes to help offset your rental income. However, important footnote, if your personal use is greater than 14 days or 10% of the rental time, you cannot claim a tax loss for the year. So you're going to have to keep records, keep track. That's how we dance with Uncle Sam and win. All right, emptying out your FSAs or flexible spending accounts. We are not big fans of flexible spending accounts, but we know some of you have them. They are use it or lose it. If you don't use the funds in there at the end of every year, it disappears like magic, and you don't know what happened. Uncle Sam does. We're big fans of HSAs, health savings accounts. So if that's something appropriate, let's look at FSAs versus HSAs and see if we're doing everything we can when it comes to our health and when it comes to tax planning. By the way, your employer may allow a carryover of up to $550 for 2.5 months. So it's use it or lose it for the most part. There are little exceptions, but the devil's in the detail, and typically I find it's not worth it. All right, some of us are also individuals and business owners. Yes, look at those loading docks. You may or may not own that particular business, but let's go look at yours. Secure employee retention credits. Yes, CARES Act, the Coronavirus Aid, Relief, and Economic Security. Congress is so good at coming up with these. Created a new tax credit, the ERC. So now we need to know about the employee retention credit. If you kept workers employed, which we tried to during the pandemic in 2020, you might have been allowed a maximum credit for $5,000. I'm hoping this is old news for everybody at this point. If you're a business owner, you probably learned about the Payroll Protection Act, PPP. You probably followed the CARES Act and the ERC. Just double check, because if you didn't, you can go back and amend. All right, start using equipment. This is a big one. Section 179 allowance. If you are buying equipment, this could be hardware, software, forklifts, updating your database, you can deduct up to $1.05 million of the cost of qualified property. The government knows you're going to have to invest in your business. They want to be your partner. They want to assist. There is a lofty phase-out threshold of up to 2.62, so based on your income, you may not get all of this. But if you go buy a piece of equipment for your business, think heavy equipment, think software, think hardwares, computer systems, you might get the benefit of the Section 179. So please work with your tax professional, your tax preparer, and they'll walk you through that. All right, this is good. Feast on business meals deduction. So in the old days, they allowed this and they took it away, and now it's back. As of today, second quarter 2022, the Tax Cut and Jobs Act, also known as the TCJA, permanently repealed the deduction for 50% of the cost of most business expenses. So if you're sitting down and you're eating, whether it's pizzas or hamburgers with kale, you're allowed to write up to 50% of that bill off if you document it and you keep your receipts. As usual, please write down the main topic, like we talked about Roth conversions, write down who you were having the meal with, and keep the receipts. Current deduction is 100% for business-related food and beverages provided by restaurants in 2022 to give them some incentive for getting people back in, because as you know, the restaurant industry has been hit pretty hard recently. All right, fixing up your business. Whether it's, well, this business doesn't need to be fixed up, it's brand new as you can tell, but your business may not be this new and shiny with all those good looking loading docks. So you can deduct minor repairs to doing business building. Cost of major improvements must be capitalized, so you have to treat repairs and capital improvements different. That's a common error that's done in tax planning. So make a note, I'm just putting a coat of paint on, or I'm actually replacing the roof. There's a difference in the code. Work with your tax professional to double check and take advantage of what's appropriate in your situation. All right, time to drive a tax bargain. Using your vehicle for business driving. You might not reimburse yourself for commuting to and from your place of business. That has to get subtracted. Don't get greedy. However, if you are using your business and you're going to networking events and functions and meeting clients and prospects and out and about, keep a log. Don't go buy a log off eBay. That's a no-no. Keep your own specific log. There's an app on your phone. There's journals. Keep in the glove box. It's a little bit of ounce of prevention, pound of cure. All right, launching a new business venture in 2021 or a retirement plan startup in 2022. The government wants you to not be dependent on Social Security. Surprise. It's been around since the 30s. They know Social Security is an ongoing system, but they want you off the system as much as possible or to supplement that with your own retirement plan. So sit down with a financial professional. I personally would advise Wise World Investment Planning and ask them if you qualify for the startup. Basically, if you do not have a retirement plan and you want to contemplate, should I do a SEP? Should I do a simple? Should I do a 401k? What are the pros? What are the cons? I'm confused. Sit down. The government will actually reimburse a certain percentage of that, up to $5,000 per year, in explaining what this is all about. They want you to get educated, and they're willing to help you with that process. All right. And also, don't forget, aim to hire targeted workers. There are certain people that the government wants you to bring in and give them a chance. So the Work Opportunity Tax Credit we mentioned earlier, WOTC, allows 40% of the first year wages of up to $6,000 per employee for a maximum credit, not deduction, but credit, which is awesome, of $2,400. They want you to consider disabled veterans. Awesome. We appreciate your service. They want to make sure they're still working. Credit may be up to the first $24,000 of wages, up to a $9,600 credit. You can see that these credits are out there. Look at the lower right corner. Ex-felons, people on food stamps that are receiving SNAP, recipients of Social Security, unemployed veterans, vocational rehabilitation referrals. There are targeted groups. The government says, please do not leave these people behind. If these are the type of people you think would make awesome employees in your organization, the government agrees. All right, avoid business interest deduction cap. The Tax Cut and Jobs Act, again, this came out of the TCJA, allows the annual deduction for the net interest expense of a business to be limited to 30% of its ATI. This is time to sit down with your tax professional and see, can I write off any of the interest? If it's for the individual, probably not. If it's interest on a business credit card, for example, maybe. So go through it, see what the software says, check all the recent regs, and see if it makes sense for you. All right, time to salvage a bad debt. Hope you've never been in this situation, but sometimes people buy our services and they say they're going to pay and then they actually never end up paying. If you've made a good effort in trying to get that money back to you or collections and you don't have anything, and you can say, well, we've called, we've emailed, we sent letters, we're trying and nothing's happening, the government will feel some of your pain and actually give you a tax break for some of that. So if you have bad debt, I hope you don't, but if you do, there might be a little silver lining here. Thanks for listening to the Town Hall, second quarter 2022, in the wild, wonderful world of tax planning. Glad you were here.